Post-clearance audit is a process undertaken by customs authorities to validate the completeness and accuracy of import and export transactions once goods have left customs custody. Post-clearance audits are beneficial to taxpayers because it allows them to analyze what they are doing wrong and then take corrective actions to make sure that they are not incurring certain penalties that could be avoided.
It is important because it helps the customs officials verify the accuracy and authenticity of information made on declarations by taxpayers.
The benefits of post-clearance to taxpayers for me are into ensuring that they themselves understand the whole customs processes. Also to know how efficient and compliant they have been in the customs process.
The post-clearance audit is conducted to ensure accuracy of declarations made to the tax authorities.
To ensure that goods are classified correctly with the HS codes, just adopt the acronym OAC. Understand the HS codes, analyze the product, review the HS codes, and consult when in doubt.
Data analytics can be used to automate compliance checks, which makes it easier for you to ensure that you're on the right path with regards to regulatory requirements. And with all that, data analytics gives you the chance to visualize your data or your trend over a period of time.
The importance for taxpayers understanding the trade agreements to be able to identify whether there are some tax incentives that are attributable to the goods that they import.
Advice to taxpayers to stay ahead. I believe they need to be aware of regulations as and when they are amended or as and when they are enacted.
No, with every relationship depends on trust. So there's the need for taxpayers and the tax officials or the customs officers to actually build that trusted relationship.
For businesses to build strong relationships with the customs authorities, they must demonstrate commitment to compliance by responding to queries promptly. They could also establish strong relationships by ensuring that they establish one point of contact with the customs authorities.
There should be a level of transparency and making sure the management is taking all steps to make sure that if there are year-end adjustments, there needs to be true-ups, there needs to be reconciliation to ensure that all these numbers for these two valuations are actually the same. And I think if any company does that, it definitely to a larger extent addresses the issue that companies are facing.
Businesses should ensure that they use the correct HS codes. They should also keep records of all their import and export documentation.
In one word, what I would describe the landscape of customs in Ghana is that it's very evolving.
Unrolling.
Complex.
Evolving.
It is complicated.
Technical.
Evolving.
Visible.
Cumbersome. Evolving.
Growing.
Post-clearance audits is a process undertaken by customs authorities to validate the completeness and accuracy of import and export transactions once goods have left customs custody. Post-clearance audits are beneficial to taxpayers.
I send it to my phone. So I don't know whether I should connect to your phone. No, not connect to my phone. But my phone, it's my phone.
Because it allows them to analyze what they are doing wrong and then take corrective actions to make sure that they are not incurring certain penalties that could be avoided.
It is important because it helps the customs officials verify the accuracy and authenticity of information made on declarations by taxpayers.
The benefits of post-clearance to taxpayers for me are into ensuring that they themselves understand the whole customs processes. Also to know how efficient and compliant they have been in the custom process.
The post-clearance audit is conducted to ensure accuracy of declarations made to the tax authorities.
To ensure that goods are classified correctly with the HS codes, just adopt the acronym OAK. Understand the HS codes, analyze the product, review the HS codes, and consult when in doubt.
Data analytics can be used to automate compliance checks, which makes it easier for you to ensure that you're on the right path with regards to regulatory requirements. And with all that, data analytics gives you the chance to visualize your data or your trend over a period of time.
The importance for taxpayers understanding the trade agreements to be able to identify whether there are some tax incentives that are attributable to the goods that they import.
Advice to taxpayers to stay ahead. I believe they need to be aware of regulations as and when they are amended or as and when they are enacted.
No, with every relationship depends on trust. So there's the need for taxpayers and the tax officials or the customs officers to actually build that trusted relationship.
For businesses to build strong relationships with their custom authorities, they must demonstrate commitment to compliance by responding to queries promptly. They could also establish strong relationships by ensuring that they establish one point of contact with the custom authorities.
There should be level of transparency and making sure the management is taking all steps to make sure that if there are year-end adjustments, there needs to be true-ups, there needs to be reconciliation to ensure that all these numbers for these two valuations are actually the same. And I think if any company does that, it definitely to a larger extent addresses the issue that companies are facing.
Businesses should ensure that they use the correct HS codes. They should also keep records of all their import and export documentation.
In one word, what I would describe the landscape of customs in Ghana is that it's very evolving.
Unrolling.
Complex.
Evolving.
It is complicated.
Technical.
Evolving.
Visible.
Cumbersome. Evolving. Growing.
Post-clearance audits is a process undertaken by customs authorities to validate the completeness and accuracy of import and export transactions once goods have left customs custody.
Post-clearance audits are beneficial to taxpayers because it allows them to analyze what they are doing wrong and then take corrective actions to make sure that they are not incurring certain penalties that could be avoided.
It is important because it helps the customs officials verify the accuracy and authenticity of information made in declarations by taxpayers.
The benefits of post-clearance to taxpayers for me are into ensuring that they themselves understand the whole customs processes. Also to know how efficient and compliant they have been in the customs process.
The post-clearance audit is conducted to ensure accuracy of declarations made to the tax authorities.
To ensure that goods are classified correctly with the HS codes, just adopt the acronym OAK. Understand the HS codes, analyze the product, review the HS codes, and consult when in doubt.
Data analytics can be used to automate compliance checks, which makes it easier for you to ensure that you're on the right path with regards to regulatory requirements. And with all that, data analytics gives you the chance to visualize your data or your trend over a period of time.
The importance for taxpayers understanding the trade agreements to be able to identify whether there are some tax incentives that are attributable to the goods that they import.
Advice to taxpayers to stay ahead. I believe they need to be aware of regulations as and when they are amended or as and when they are enacted.
No, with every relationship depends on trust. So there's the need for taxpayers and the tax officials or the customs officers to actually build that trusted relationship.
For businesses to build strong relationships with their custom authorities, they must demonstrate commitment to compliance by responding to queries promptly. They could also establish strong relationships by ensuring that they establish one point of contact with the custom authorities.
There should be level of transparency and making sure that management is taking all steps to make sure that if there are year-end adjustments, there needs to be true ups, there needs to be reconciliation to ensure that all these numbers for these two valuations are actually the same. And I think if any company does that, it definitely to a larger extent addresses the issue that companies are facing.
Businesses should ensure that they use the correct HS codes. They should also keep records of all their import and export documentation.
In one word, what I would describe the landscape of customs in Ghana is that it's very evolving,
unrolling,
complex,
evolving,
complicated,
technical,
evolving,
simple,
cumbersome, evolving, growing.
Post-clearance audits is a process undertaken by customs authorities to validate the completeness and accuracy of import and export transactions once goods have left customs custody.
Post-clearance audits are beneficial to taxpayers because it allows them to analyze what they are doing wrong and then take corrective actions to make sure that they are not incurring certain penalties that could be avoided.
It is important because it helps the customs officials verify the accuracy and authenticity of information made on declarations by taxpayers.
The benefits of post-clearance to taxpayers for me are into ensuring that they themselves understand the whole customs processes. Also to know how efficient and compliant they have been in the customs process.
The post-clearance audit is conducted to ensure accuracy of declarations made to the tax authorities.
To ensure that goods are classified correctly with the HS codes, just adopt the acronym OAK. Understand the HS codes, analyze the product, review the HS codes, and consult when in doubt.
Data analytics can be used to automate compliance checks, which makes it easier for you to ensure that you're on the right path with regards to regulatory requirements. And with all that, data analytics gives you the chance to visualize your data or your trend over a period of time.
The importance for taxpayers understanding the trade agreements to be able to identify whether there are some tax incentives that are attributable to the goods
that they establish one point of contact with the custom authorities.
There should be level of transparency and making sure the management is taking all steps to make sure that if there are year-end adjustments, there needs to be true ups, there needs to be reconciliation to ensure that all these numbers for these two valuations are actually the same. And I think if any company does that, it definitely to a larger extent addresses the issue that companies are facing.
Businesses should ensure that they use the correct HS codes. They should also keep records of all their import and export documentation.
In one word, what I would describe the landscape of customs in Ghana is that it's very evolving.
Unrolling.
Complex.
Evolving.
It is complicated.
Technical.
Evolving.
Visible.
Cumbersome.
Evolving. Growing.
Post-clearance audits is a process undertaken by customs authorities to validate the completeness and accuracy of import and export transactions once goods have left customs custody.
Post-clearance audits are beneficial to taxpayers because it allows them to analyze what they are doing wrong and then take corrective actions to make sure that they are not incurring certain penalties that could be avoided.
It is important because it helps the customs officials verify the accuracy and authenticity of information made on declarations by taxpayers.
The benefits of post-clearance to taxpayers for me are into ensuring that they themselves understand the whole customs processes. Also to know how efficient and compliant they have been in the customs process.
The post-clearance audit is conducted to ensure accuracy of declarations made to the tax authorities.
To ensure that goods are classified correctly with the HS codes, just adopt the acronym OAC. Understand the HS codes, analyze the product, review the HS codes, and consult when in doubt.
Data analytics can be used to automate compliance checks, which makes it easier for you to ensure that you're on the right path with regards to regulatory requirements. And with all that, data analytics gives you the chance to visualize your data or your trend over a period of time.
The importance for taxpayers understanding the trade agreements to be able to identify whether there are some tax incentives that are attributable to the goods that they import.
Advice to taxpayers to stay ahead. I believe they need to be aware of regulations as and when they are amended or as and when they are enacted.
No, with every relationship depends on trust. So there's the need for taxpayers and the tax officials or the customs officers to actually build that trusted relationship.
For businesses to build strong relationships with the custom authorities, they must demonstrate commitment to compliance by responding to queries promptly. They could also establish strong relationships by ensuring that they establish one point of contact with the custom authorities.
There should be level of transparency and making sure the management is taking all steps to make sure that if there are year-end adjustments, there needs to be true ups, there needs to be reconciliation to ensure that all these numbers for these two valuations are actually the same. And I think if any company does that, it definitely to a larger extent addresses the issue that companies are facing.
Businesses should ensure that they use the correct HS codes. They should also keep records of all their import and export documentation.
In one word, what I would describe the landscape of customs in Ghana is that it's very evolving.
Unrolling.
Complex.
Evolving.
It is complicated.
Technical.
Evolving.
Visible.
Cumbersome.
Evolving. Growing.
Post-clearance audits is a process undertaken by customs authorities to validate the completeness and accuracy of import and export transactions once goods have left customs custody.
Post-clearance audits are beneficial to taxpayers because it allows them to analyze what they are doing wrong and then take corrective actions to make sure that they are not incurring certain penalties that could be avoided.
It is important because it helps the customs officials verify the accuracy and authenticity of information made on declarations by taxpayers.
The benefits of post-clearance to taxpayers for me are into ensuring that they themselves understand the whole customs processes. Also to know how efficient and compliant they have been in the customs process.
The post-clearance audit is conducted to ensure accuracy of declarations made to the tax authorities.
To ensure that goods are classified correctly with the HS codes, just adopt the acronym OAK. Understand the HS codes, analyze the product, review the HS codes, and consult when in doubt.
Data analytics can be used to automate compliance checks, which makes it easier for you to ensure that you're on the right path with regards to regulatory requirements. And with all that, data analytics gives you the chance to visualize your data or your trend over a period of time.
The importance for taxpayers understanding the trade agreements to be able to identify whether there are some tax incentives that are attributable to the goods that they import.
Advice to taxpayers to stay ahead. I believe they need to be aware of regulations as and when they are amended or as and when they are enacted.
No, with every relationship depends on trust. So there's the need for taxpayers and the tax officials or the customs officers to actually build that trusted relationship.
For businesses to build strong relationships with the custom authorities, they must demonstrate commitment to compliance by responding to queries promptly. They could also establish strong relationships by ensuring that they establish one point of contact with the custom authorities.
There should be level of transparency and making sure the management is taking all steps to make sure that if there are year-end adjustments, there needs to be true-ups, there needs to be reconciliation to ensure that all these numbers for these two valuations are actually the same. And I think if any company does that, it definitely to a larger extent addresses the issue that companies are facing.
Businesses should ensure that they use the correct HS codes. They should also keep records of all their import and export documentation.
In one word, what I would describe the landscape of customs in Ghana is that it's very evolving.
Unrolling.
Complex.
Evolving.
It is complicated.
Technical.
Evolving.
Visible.
Cumbersome.
Evolving. Growing.
Post-clearance audits is a process undertaken by customs authorities to validate the completeness and accuracy of import and export transactions once goods have left customs custody.
Post-clearance audits are beneficial to taxpayers because it allows them to analyze what they are doing wrong and then take corrective actions to make sure that they are not incurring certain penalties that could be avoided.
It is important because it helps the customs officials verify the accuracy and authenticity of information made on declarations by taxpayers.
The benefits of post-clearance to taxpayers for me are into ensuring that they themselves understand the whole customs processes. Also to know how efficient and compliant they have been in the customs process.
The post-clearance audit is conducted to ensure accuracy of declarations made to the tax authorities.
To ensure that goods are classified correctly with the HS codes, just adopt the acronym OAK. Understand the HS codes, analyze the product, review the HS codes, and consult when in doubt.
Data analytics can be used to automate compliance checks, which makes it easier for you to ensure that you're on the right path with regards to regulatory requirements. And with all that, data analytics gives you the chance to visualize your data or your trend over a period of time.
The importance for taxpayers understanding the trade agreements to be able to identify whether there are some tax incentives that are attributable to the goods that they import.
Advice to taxpayers to stay ahead. I believe they need to be aware of regulations as and when they are amended or as and when they are enacted.
No, with every relationship depends on trust. So there's the need for taxpayers and the tax officials or the customs officers to actually build that trusted relationship.
For
Good morning, everyone. I trust we are all doing well. My name is Ruby Emefa Kluche, a manager in the tax unit of KPMG in Ghana, and I'm delighted to be your moderator for today. We'll give about 2 minutes for our participants to settle in, and then we will proceed. Hi, everyone. You are warmly welcome to the Future Ready Insurance Series. This initiative is a collaboration between KPMG and the Ghana Insurers Association, GIA. It has been designed to empower stakeholders in the insurance industry with the knowledge and tools needed to conduct business more efficiently and effectively. Today marks the maiden edition of the series, and it is going to be focused on transfer pricing for insurance. This webinar has been carefully designed to deepen our understanding of Ghana's transfer pricing regime as it applies to the insurance sector. We will explore key risks, strategies for effective management, and practical steps to enhance compliance. Please take note of the following housekeeping rules. We will have a Q&A session at the end of the presentation. When it's time, kindly raise your hand and you'll be prompted to unmute. Also, as the session is ongoing, please feel free to drop your comments in the chat box and we would attend to them appropriately. As I earlier mentioned, this is a collaboration between KPMG and GIA. On that note, please join me to welcome the CEO of GIA, Dr. Kingsley Kwesi Kwabasin, to deliver the opening remarks for the webinar. Thank you. Hello, Doc. If you are speaking, you are muted. Okay, Doc, you can unmute now. Your speaker has been enabled.
Good morning. Please, can you hear me?
Yes,
Loud and clear.
Yes. On behalf of the board and members of the Ghana Insurance Association, we are excited to have you on this maiden edition of the Future Ready Insurance Series. This is a partnership between KPMG and GIA. And the idea is that there are certain issues that we don't really think about, because when we are so much involved in chasing premium and meeting targets, we tend to forget about simple things. This series seeks to draw attention to those things that are very relevant, but then we oftentimes ignore. That is not to say that we will not delve into other issues that you are familiar with, just to broaden your knowledge. We are in talks with the various professional institutions, CIAG, Ghana Insurance College, among others, so that participating in this will count towards your CPD. We mix practice with theory, just so that we stay on focus and it becomes very relevant to your operations. Please, we would want you to take active role in all our series, just to enable you be abreast with trending issues and even the untrending ones, to the extent that they relate to your work. Transfer pricing is very critical, because so long as you are we have the trend of group operations trending in our terrain. We know that parties within the group will be trading among themselves, will be transferring and selling or exchanging prices, goods among themselves. And in doing so, the principles of arm's length and others come in, just so that we don't fall foul of the law. Let me leave the presentation to the experts for them to give us the direction as to how we can prevent the legal issues related to this issue called transfer pricing, with specific reference to the insurance transactions. On that note, thank you very much for the opportunity, and please enjoy the session. Thank you very much.
Thank you so much, Dr. Kwabasing, for setting the ball rolling for us. I would move on to introduce our facilitator for the day. He is Mr. Michael Boateng. Michael Boateng is a partner in the tax unit of KPMG Ghana. He heads the transfer pricing section of the tax unit and has been providing tax and advisory and compliance services for companies across several sectors of the economy for over 15 years. Michael has advised clients on various aspects of Ghana's transfer pricing regulations and represented clients during transfer pricing audits by the Ghana Revenue Authority. Additionally, he has led and participated in a number of seminars and training programs with the Institute of Chartered Accountants Ghana. He is a member of the Chartered Institute of Taxation Ghana and the Institute of Chartered Accountants Ghana. Please join me to welcome Mr. Michael Boateng, our facilitator for the day.
Good morning, everyone. Thank you, Ruby, and thank you, CEO, for your warm remarks. And thank you, everyone, for taking time to attend this our webinar. We believe by the time we finish, we would have gone through the key points which were raised by the CEO, especially talking about how topical and how critical transfer pricing issues actually is to the insurance business. So today we are definitely going to look at how transfer pricing in Ghana actually affects the insurance business in Ghana. As my colleague actually indicated, one of the key rules is that we are going to have a Q&A when the presentation is done, so that at least each and every one of us can share or even have the opportunity to seek clarification to some of the issues. One key request is that any request or any question should be on a no-name basis. This is to ensure the privacy of companies' information. So thank you once again, and thank you for the opportunity to accept the invite to attend this wedding webinar. Now, transfer pricing has been one of the most topical issues in Ghana. And I think if you look across the globe and recent research across industries worldwide, almost about 80% of CEOs and business leaders see transfer pricing as a very important area in terms of their compliance. And I think there are certain key aspects to it. One issue that we also see is that governments have also been very aggressive in transfer pricing, all in the interest of ensuring that companies or their taxpayers are paying their fair share of revenue in their jurisdictions. And I think Ghana Revenue Authority is of no exception. I believe we might have all heard about transfer pricing audits and requirements and those things. So as we are going through, we are going to go through some of the key areas just for your information. Now, if you look at the content, we are going to give a brief background of transfer pricing. We'll focus on what it is, why it is important, the key regulations that actually governs transfer pricing in Ghana. We talk about some of the key information that are needed. And we actually go further to give you appreciation of why you need this information and what is the purpose of that. Then we will delve into specifically within your industry, that is the insurance industry. We know in Ghana, we typically have the non-life and then life and then reinsurance. We will look at some of the key value chain aspects of it, some of the key processes, and why you may need to ensure that when you reach each of these processes or points in your operations, you know what is expected of you. Then we will look at some of the what you call the penalties and the interest. I mean, for when you actually fringe or you don't comply with these regulations, some of them can be very punitive. And I think that is the key thing. I think that's what makes transfer pricing such an important topic to discuss. Now, when you come to the background of transfer pricing is nothing more than a reference to the prices and fees charged for transactions among related parties. So here we are looking at prices or fees which are being charged among related parties, and it's for goods and services, products, and others that you may have. Now, if you look at this definition, the key point which is actually driving it is fees and prices. And why are they important? These are some of these items or transactions that affect our chargeable income or tax liability. And therefore, as a revenue authority, or as a revenue officer, they want to ensure that these prices are actually being reflective, or they are fair, or they are reasonable as it is, so that it doesn't change any tax position, that because it's to the benefit of the tax authority. And I think that is what is driving this whole idea about transfer pricing. Now, if you delve further, what you tend to find is that transfer pricing is sitting on the pillar of what we call the arm's length principle. Now, there have been various definitions or various clarifications to the arm's length principle, which more or less, look at the fact that this amount which demonstrates that the amount charged by one related party to its unrelated party actually is reasonable, because that is the key point. So now that we've talked about the arm's length principle and what it stands for, we're looking at what is driving transfer pricing in terms of the key regulatory requirements. So the points that we are looking at are that, one, it is mandated by our tax law. If you look at our Act 896, transfer pricing actually been boldly, clearly required. And it gives just a brief about what the transfer pricing requirements will be. Now, if you look at the regulations, which actually gives more clarifications on how the act or the section of the act actually has to be implemented. That's the transfer pricing regulations LI 2412. Here we look at the key steps in complying with the key section of the transfer pricing regulations. Now, you take a step back, we talked about the arm's length principle, which actually is supposed to be the key pillar of transfer pricing. What then is required is that as a taxpayer or as a business leader, to be able to comply with the arm's length principle, there are certain key documentations or reports that are expected of you to actually to have in place. The law has clearly stated that there are about four key of them. We have the annual transfer pricing returns, we have the transfer pricing local file, we have the transfer pricing master file, and we have the country by country report. These four documents or reports are required as a basis of demonstrating that if you are having a robust transfer pricing process, you are actually complying or having this information in place. Now, in addition to this, there is a key pivotal point in having this documentation in place, and that is the law has actually further clarified that in all the basis in terms of coming up with the basis of charging the related party transactions, the law has clearly given us 5 methods that has to be used. So these 5 methods are you see on the screen. We have the comparable uncontrolled price method, we have the resale price method, we have the cost plus method, we have the transaction net profit margin, and then we have the profit split method. Now, anybody can ask me that, what are these for? If you take a step back and look at practice, what this shows us is that each and every one of them is actually suited for certain transactions. And failure to use these key transactions or select these methods actually can expose a taxpayer to unnecessary adjustments. So for instance, if you look at what we are calling the comparable uncontrolled price, which is a cap method, this method actually is saying that, look, if you want to make sure that you want to demonstrate that transactions between yourself and your related party, let's say company A, company B, is comparable to what company C and D, who are unrelated, are actually charging. And therefore, if you compare the two and they are similar, then that shows that the transaction that we are charging among ourselves, that's A and B, are at the arm's length. Now, if you delve in further with this method, the method is actually focusing on 2 key things. When this method is looking at comparability, it's looking at the physical features of a product and then in terms of similarity. So for instance, if I'm company A and my related party is company B, I grow oranges and then I sell to my related party who is company B. Now, if I want to make sure that what I'm charging my related party company B is at arm's length, I need to go into the market and look at physical features of similar products. In this case, I'm going to look for oranges. And then I'll say, okay, this is orange, this is the taste, this is the size and everything that the unrelated parties are charging. Therefore, if I say that is comparable or they look similar or comparable to what I'm charging, then by using the cap method, that means that there is arm's length principle. And as I indicated earlier on, the cap method is looking at the physical features of the product. Now, it cannot be said the same when it comes to the cost plus or the transaction net margin. Now, if you look at the cost plus or the transaction net margin, these methods are looking at the profitability of products or services. So in this case, if I am company A and my related party is company B, and I'm providing services to company B, and we want to demonstrate to the revenue authority or to third parties that our arrangement is comparable, what we are going to do is that if in all circumstances we don't have similar products or similar services to compare, we can say that we want to compare the profitability of companies that does similar things. So therefore, if you go into the market and we find companies who actually provide similar things, and then we've picked their financial statements and know that we know their profit, their net profit margins, whether it is operating margin and others. As long as those margins or whatever we pick are comparable to what we are charging, therefore it is arm's length.
So from what we are gathering, you could see that each method is so geared towards another for specific transactions, and failure to understand them and pick the appropriate method can expose you to a number of transfer pricing adjustments or this. And then I think that is where the infractions and the interest that to be charged and those things become very punitive. So it's quite important. It's so important that companies, as you're operating your business, you are preparing your transfer pricing documentations and others, just don't just be ignorant of what method is being used. Why are they using this method? Is it suiting the transactions? Are there any loopholes? You need to delve into that to actually give yourself that comfort. Now, after you've gone through these methods, the next one that we also look at in terms of the background is where you are also looking at, as I indicated, the methods, the documentation. So here we talked about what the laws that you need to comply. We talked about the methods that you may have to actually, select. And within that, we talked about the transfer pricing, the arm's length principle. Now, we indicated that there are about 4 key reports or information that would demonstrate that the transaction that we are looking at is at arm's length. So the first one, as you see on the screen, is the transfer pricing annual returns. Now, these are returns that actually comes into place when you have transfer pricing related party transactions and you are actually need to report it to the GRA. So this is typically a 5-page declaration form, which actually entails the transaction that has been occurred in the year, the amounts that were charged, the related parties that you dealt with, how much has been, charged, the method that you use, and everything. This actually has to be filed with the GRA 4 months after your year end. Actually goes, it goes the same process or same implications as your annual transfer pricing, your annual corporate income tax returns. The next one is the transfer pricing local file. This is one of the key reports or local file information that you need to have to demonstrate that your transaction that you have is actually at arm's length. Now, this also has to be filed 4 months after your year end. It actually gives details about the information, about the method, your strategy, and everything. And I think it is one of the key documentation that are needed to support that you are actually complying with the arm's length principle. The next one is what we call the master file. So the master file also actually provides a high-level overview of the entity's global operations, the policy that you are using, the methods that you are using, and others. It's also needed to be filed 4 months after the year end, just as the previous 2 reports. Now, the key thing that we need to take away from here is that the local file and the master file are termed as contemporaneous reports. So what does it mean? It means that as the transactions are ongoing throughout the year, you need to make sure that they are actually being reflected in your transfer pricing local files and your master file. The challenge that we've seen is that a lot of taxpayers wait about a year or 2 after the transactions has occurred. They have been recorded in your financial statements, you have filed with the GRA, you've also prepared your corporate income tax returns, and now you are now going to prepare a local file and a master file. When that happens, you are just documenting something that is after the thought. You are likely to miss a lot of information, evidence of performance, and other things. And that's one of the key areas that we've seen a lot of taxpayers actually missing. And when you miss that, you expose yourself so much to transfer pricing adjustments. The last one is what we call the country-by-country report. This report actually basically summarizes the global financial operations or activities of the group which entails all the related parties across the globe. The interesting thing is this one is supposed to be filed 12 months after your year end. So with all these 4 reports and files, returns and others that we talked about, it is so important, and from where we sit is that a lot of taxpayers may have them, but the question is that are they reflective of what the activities are, the transactions are? And I think that is one key. The management will have to reassess year-on-year basis to see that all this information, yes, you may have them. Do they actually have, is a true representation of your operations? which is one of the key things that you need to look at. Now that we've talked about the methods and other things, we are talking about the arm's length principle. Now, the arm's length principle, as we've indicated, is actually talking about the two key points, and I think that's what's driving transfer pricing. Now, if you look at on the screen, there are two silos. One bubble is saying that, are you acting as a prudent business manager? What does it mean? That means that if you have related party transactions and you are being charged or you are charging your related party, are you acting as an independent business or prudent manager? Because as an independent prudent manager, you are going to ensure that whatever you are going to charge or be charged will be something that will have value, something that you have actually received the services for, something that actually gives you economic or commercial value, and something that an independent person will pay for. So the key question that goes through your mind as you are being charged any of these transactions is what you need to look out for. That is, are you acting as a business manager? The second bubble actually talks about the pricing to be determined between the related parties. Are you having the process or the robust analysis to ensure that this is similar to what unrelated parties or third parties will be willing to pay? And I think when you are looking at transfer pricing from audit perspective in terms of implementation and documentation others, these key things are what should drive you. Therefore, if you receive an invoice for a management service or technical fees and others, are you sure that what you are paying for, you are acting like a prudent business manager? And have you ensured that if there are third parties involved, or if you compare it to what third parties are charging for, they'll be willing to pay for that? And I think as business leaders, these are the things that you need to look out for. Now let's come to transfer pricing within the insurance sector. What we've done on this screen is just to give an overview of what happens typically in the insurance sector. We talked about whether it's life, whether it is general, whether it's reinsurance. These are the key key points in your value chain, which typically may generate transfer pricing processes or issues. So for instance, if you take a typical insurance company, the key point that you may have on point one is the product development. And what do you mean by product development? As insurers, you may have people, designers or others who sit down and say, look, we want to come out with a product. We want to look at the product that may service either as a funeral insurance, whether it is auto insurance, whether it's a combo, whether for life, savings and others. Now, the reason why this is so important is that companies that operate within what we call a multinational group or from a group perspective, there typically seems to always have a centralized or a more like an agreed way of developing such products. And to make it easier and to ensure seamless operations and effectiveness, companies from a group perspective tend to have this support from a group perspective. The question is that when this support is being provided, are you actually having the proper documentation and others to demonstrate that if there are any charge that may come from, or if there are no charge, are they at arm's length? That's the key question. The next question, the next point that you look at in the typical value chain of an insurance company is the marketing and distribution of insurance policies. So here we are looking at how the insurance products are actually marketed. So in this case, now these days we have online platforms. It can be through so many means. You can be in person. It can be other ways of other things that are developed. The question is that from a group perspective, we've seen that companies want to leverage on best practices. So you may have a multinational entity or even companies within a group, whether they are in Ghana, group in Ghana, or others. Just rely on a template or very similar processes to roll out the marketing products. So I think one of the key things is whenever you are receiving such support or you are providing such support from your related party in your value chain, do you get charged? And how do you ensure that whatever you are being charged is at arm's length? Then we come to the point of underwriting. So in this case, you have developed the product. You've actually come up with your marketing strategy, means you are going to do that. Now people are coming in, they want to sign up. That's where the underwriting actually takes place. So here you need to have risk assessment, determine the premium based on the profile and others. The question is that this is also an area where companies within groups are actually going to rely on best practices within the group or something to make sure that they leverage it across the group of entities. The question is, if you are being charged or you are supposed to charge for the provision of that service to your related party, how do you go about it? And are you ensuring that you have the proper documentation from the arm's length perspective? We also have reinsurance. We also have the claim, point 4, where at this point, companies may have claim processes. So in this case, it goes as the previous ones, where you may have to rely on where there's know-how in terms of claims management and others. And finally, you may have customer service when people may have issues that they may have to support, whether they are database system, there are IT support and others that will be used to support that. These are the key value chain points in the value chain that may generate transfer pricing issues because you may need related party support in undertaking that. We should be mindful that transfer pricing is so focused on related party transactions. Therefore, if you are receiving this from unrelated parties, then transfer pricing doesn't come in. Another area which we have seen from our appreciation in terms of the insurance industry is where you can have contribution arrangements or maybe share services. So you can have a company or a group of companies, an insurance company, life, non-life, they are operating maybe under a similar name. They may have what you call maybe a share services in terms of staff. It could be buildings, rent, and all those things. How are those arrangements actually undertaken? There could be shared services, whether it's IT, whether it's a financial support, financial reporting. How do we ensure that the appropriate allocation is done? There could also be reinsurance, where you may cede certain risk to your related party. You see certain aspects of insurance policy to your related party. How do you ensure that you get it done? Then there's also intercompany loan arrangements. So how do you ensure that this one is also actually done in terms of transfer pricing point of view? Do you have the right information, the right documentations? Now, if you look at the product development, as we mentioned, we talked about how multinational companies or group may actually have a centralized actuarial functions or group that will come up with the product. So the question is that when that is being done, the possibility of a shared services, there could be technical know-how in terms of marketing and all those things. The next question is that what are the key mitigating factors? So when we look at the key mitigating factors, as we rightly indicated earlier on, do you have the proper documentation in terms of the local file? Have you prepared something that shows that, look, I've gone through this, I've documented the transaction, these are what we are being charged for. We've selected the right transfer pricing policy, and we've actually taken and to ensure that in terms of if there are more or less any shared services or any IT support, we have come up with the appropriate way of allocating the services across board. We've also gone through a benefit test. Remember, one of the key things from a arm's length point of view is that are you really getting financial and commercial benefit? You need to have all those analyses taking place. You also have to make sure that if you are charging, do you have the appropriate benchmark and analysis and cost basis to actually determine that? Because all these things have to be properly verified, done to ensure that you are demonstrating that everything you have in place is in compliance with the arm's length principle. The next one that we can talk about is the so we've done the product development, you are doing your underwriting. So here, as we indicated earlier on, you may rely on support from the parent company, or maybe there is central arrangement or central best practice that is shared across the group that each and everyone, so every subsidiary in each jurisdiction needs to comply with in terms of how to underwrite policies. So how do you go about it when you are receiving this support in terms of premium determination, in terms of others? Do you have the proper documentation in terms of, if I am relying, let's say I'm in Ghana and my parent company is in Germany, and my parent company is actually providing us with support in terms of templates of how to underwrite. Maybe there could be local aspect to it, but there could be certain standards in terms of risk management. Are we paying for that? How do we ensure that even the benefit and all those things that are being done, that we are generating, we are documenting them and we know them? And then also what methods have been used. And it's very vital to demonstrate that this support at arm's length, as we've said it earlier on, Additionally, you also want to ensure that if there are premiums that are to be charged or to be ceded in terms of captive insurance and others, you are actually ensuring that it's actually in accordance with the arm's length principle. So we talked about the underwriting. We talked about some of the risks that may take place, whether it's reinsurance or maybe, and then some of the mitigating points that you need to take. Are you having the proper documentation to show all those control functions? And it's quite important that one of the key things that we're seeing is that if you are ceding something or you are ceding a risk to a related party, do they have control? When I say control, are they able to assume those risks? These are key things that are coming up in recent transfer pricing issues. So that if you are ceding to somebody or to another related party or something, and it's determined that they cannot have or the capacity to undertake such risk, how would it be deemed? So these are all issues that need to be looked at for. We also talked about the reinsurance. So here, the reinsurance in terms of determination of the premium, in terms of how the premium is done, the analysis that are taking place, what mitigation factors are you putting in place? And I think it's so important that when you are looking at the reinsurance aspect, even though there could be regulatory aspects to it, but if you are ceding, how is the risk being determined? Are you just giving it to a related party because you are not being acting like a prudent manager? Are you ensuring that there are adequate business reasons and substance to the transactions as we indicated? That the reinsurance have the capacity and the risk to control any risk that they are assuming? And as I indicated, one of the key things that you need to have is to ensure that the transfer pricing study or process that you have is so robust and comprehensive to ensure that, one, you are picking the right transfer pricing method, you are documenting the key process, all the value chain analysis, you are actually indicating what is actually you are receiving for. And one of the key things, example that we can share with you is there was a recent case that we were handling where a company in Ghana was being charged for marketing support services. Now, during the audit, we were finance people who had gone in, and the authorities were raising that, why are you paying for this marketing support service whilst they know that you have a very solid market team with a lot of people, qualified people? Why are you still paying for additional market support? It's quite interesting that when we brought in the head of marketing, and he was head of marketing Kumaiti, then he came in and said, look, now we are promoting our products online, and we are relying on cookies and others, so that if anyone visits our site, the cookies could track them and then show their spending pattern. That all fits into our marketing strategy. It was quite revealing to me. And I think by demonstrating that in the meeting, the authorities realized that the company is actually complying with the arm's length principle, showing that, look, we are acting like businessmen. We are showing you that we are getting value. We demonstrated that these are things that third parties will charge, be willing to charge or pay for when they go through that. And I think this should be the key theme that go through almost all transfer pricing processes as we are going through these requirements. Now, one key area which you've seen is the interest on intercompany loans. We've seen that this is something that a lot of companies or insurance companies and other entities are actually going to need. You may need financial support down the line. This financial support actually comes with interest on loans. It could be other charges and those things that you have to pay for. The question then is, are these interests and these charges, are they actually reasonable? Have we done the proper documentation to support that unrelated parties will be willing to pay for that? Are you sure that even the person giving you the loan has the capacity for the loan? Are you sure that even if you're looking at your financial position, you are likely to be given such a loan? Now, this loan issue that we are discussing, the question then is, if it is determined that either you, the borrower, you don't have the financial capacity to actually get a loan from the open market, it can be determined that the interest, the loan itself, can be converted into equity. Therefore, your companies giving you money can be considered as additional equity. Therefore, there will be no interest that will come out of it. Any charges that would have come from as the form of interest will be determined as dividend, which is quite interesting. So the question is that, as finance managers, when we are going through these loans, we are making these arrangements, are we actually having the proper documentation to support that? Are we actually going through the whole value chain in terms of ensuring that we can demonstrate to third parties that we really need this loan. And I think that is one of the key things that we've seen a lot of taxpayers missing, which actually have led to a lot of transfer pricing disputes. So we talked about the claim management. Here is one key area where we know that companies may rely on the use of IT know-how processes to ensure that whatever is being paid is actually flowing through companies' policies from a risk perspective and others. Companies or related parties will not provide these things for free, and they will charge for that. There could also be cost arrangements where, as we indicated, cost contribution arrangements and central, that all feeds into that. Do you have the proper documentation to support that? Are you demonstrating that there's a benefit for that? Which method am I using? Am I even going to say that even I'm not paying for this? What is the strategy? What is the reason why I'm not going to pay for this? And it will interest you to know that in transfer pricing, it's not every benefit that you receive that you have to pay for, but you always have to demonstrate and give the rationale why you don't have to pay for something, because it's business strategy. And all these things have been accommodated in our transfer pricing regulations. So if you are going through such charges and you decide not to be charged or to charge, you need to go through the proper steps in ensuring and demonstrating to someone that, look, this is what we are doing, this is a strategy, and we are not going to charge for it. And this is the reason. And I think these are some of the key issues that typically come out when we're dealing with transfer pricing issues. We talked about the customer service in terms of the marketing strategy that one needs to have. And one of the things that is coming up when it comes to the marketing strategy and intangibles is whenever you are in a group whereby you are being charged for certain intangibles, whether it is for the brand, which is for certain know-how. Now, there is something that we call the DEMPI analysis, which is actually talking about in terms of intangibles. How do you value how much you need to be charged? This is an area that actually has posed a lot of issues. And the new transfer pricing regulations actually accommodates that. We've seen a lot of taxpayers not having the proper documentation to support that. And I think as insurance operators, whenever you find yourself in this situation, ask yourself the question that if there are intangibles being involved, are we actually following through the DEMPI analysis to ensure that everything is fine? So we've talked about the cost sharing arrangements, interest on intercompany loan. We talked about share services, and I think it's so proper that you have that. Now, in terms of the mitigating issues, it goes back to the point that we need to have the proper documentation to support evidence of the receipt of this service or performance of these services. We need to do a benchmark analysis. So when we say the benchmark analysis, it's nothing less than saying that, look, I'm assessing what third parties are charging, and therefore when I compare them to what we have, it is comparable, and therefore we are willing to pay for it. Do you have the proper cost allocation or benefit share? If let's assume that 2 or 3 companies contribute to a certain project and they are sharing the benefits, are you ensuring that all the cost allocation basis and the benefit share are properly documented? Do you have a proper transfer pricing benchmark to support when you have other fees and interest when you are dealing with intra-group financing? I think these are the key points that typically tend to happen when we have transfer pricing issues. So at this point, if you take a step back and look at where we have come from, we talked about what is transfer pricing. We talked about what the regulation requires. We talked about the key information that are needed. We've talked about the arm's length principle. We talked about issues that happens within the insurance industry. We talked about some of the mitigating factors that need to be taken in place to address any transfer pricing exposure. Now we are talking about interest and penalties. So as the regulation, as the Revenue Administration Act actually has, come up with, whenever you have underpaid, unpaid taxes, you have interest that needs to be charged. And I think one of the things that we've seen is that these interests actually drives the tax liability when it comes to transfer pricing. Let's say we have a tax assessment or tax liability of, let's say, about 50 million Ghana cedi total. You're going to find that the principal is around 10 million. The interest will drive to almost 40 million. The question is that, could you have avoided the payment of additional 40 million? That is money that companies have spent their sweat and blood in terms of undertaking marketing activities, risk assessment, underwriting, going through claims. You have made this business, you have made this revenue, and now you are now going to give the money away. And I think that's the challenge that we want to avoid. We also have interest on penalties. We talked about penalties in terms of not filing reports and others on time. Now we've seen that the revenue authorities have actually been very aggressive on this. What this means is that if you haven't been filing in the required documentations, whether it's local file, master file, and then transfer pricing returns, now they are assessing penalties on that. We have the 500 Ghana cedis one time and 10 Ghana cedis per day. It will interest you to know that some of the times they will put all this together and it becomes so huge, a number for taxpayers to pay. So I think at this point we've gone through the issues. We've identified the key points. What we have to do is that now we've reached the question and answers. Anyone who has a question, either you can raise your hands, but I cannot see you, so you can mute yourself and then ask the question, or you can put it in the chat box to make sure that we can address it for you. And as I indicated earlier on, it should be on a no-name basis for privacy issues. So thank you so much for your time, and I hope that this has been beneficial to you. So now the floor is yours. Thank you.
Thank you so much, Michael. That was indeed a very insightful session. My key takeaways from this session is to always evaluate the pros and cons of each transfer pricing method before selecting the ideal one. And proper documentation is very key to mitigating risks. It's something that runs across all the mitigation strategies. And also local and master files are contemporaneous, meaning that these files must be prepared and updated at the same time that the control transactions are happening. So like Mr. Barton rightly stated, it's time for questions and answers. Please raise your hand and we would unmute your microphone so that you can ask the question. The chat box is also available. Thank you.
So someone raised a question on the safe harbor rules within the transfer pricing regulations. Thank you so much. I think this is Julius. Now, the question is, what is a safe harbor? A safe harbor rule is just a benefit that transfer pricing rules and regulations gives to taxpayers so that they don't have to go through preparing such voluminous information in relation to certain minimum transactions. So it's a benefit that the tax laws from transfer pricing point of view tend to give. Now, if you look at our transfer pricing regulations, we have certain safe harbor rules. The first one is whenever you have a transaction among your related parties within a year, and this goes on a transaction by transaction basis, and one of the transactions or these transactions are less than 200,000 USD. What this means is that you don't have to prepare a local file for that transaction and a master file for that transaction. So for instance, I'm company A and I'm providing services to my related party, or I'm receiving services from my related party, company B. Now, for year one, the only transaction that we are considering is management services. Now, we determine or we realize that the amount that I'm being charged for management services in Ghana is less than 200,000. To that effect, I wouldn't have to prepare a full transfer pricing report for both a local file and a master file for the transaction of management service alone, as long as it's less than 200,000. However, I will have to prepare a transfer pricing returns to demonstrate that or to report this transaction, and as I'm reporting I'm filing the transfer pricing returns, I have to take that I'm relying on a safe harbor rule for, or you call it simplified approach for this transaction. So that's the first one. So here we are looking at a 200,000 threshold. Now, let's say in year 2, I have 2 transactions, a management services and interest on intercompany loan. Same, management service is less than 200,000. Interest on intercompany loan is assessed with more than 200,000. What this means is that I have to still prepare a transfer pricing return. However, because the interest on intercompany loan is more than 200,000, I will prepare a full transfer pricing local file and master file for the interest on intercompany loan. So that is the point on the safe harbor. That is if you're looking at the amount, that is the 200,000. There is also another element, what we call low value services. Now, the regulation is saying that, look, if you have certain low value services and you are charging a markup of around 3% or so, in this case, it will be considered as a low value services. Therefore, you don't have to, you have to select as the safe harbor rule, or you are going to now go under the simplified approach. However, if you look at that definition of what we call low value services in our regulations, it makes it so difficult that by the end of the year, you will realize that you don't even qualify. So that's one thing that always comes up. The last one is where you have an agreement which support management service and others which have been approved by GIPC, but then it's saying that this the amount that needs to be charged is around 3 or 4% of your profit before tax. So when you have that, you can still fall under the safe harbor rule. But as I indicated, it typically exempts you from both the local and the master file, but not the returns and maybe country by country report if you have to. Thank you.
Thank you so much, Michael. I noticed there are other questions in the chat box. I'll take a question from Mr. Aaron Pakis. Assuming their management fees or TTA agreement has been approved by the GIPC and its rate applied on net sales, how is that supposed to be applied under the transfer pricing rule? I'll add the last one. Please, can you explain the OECD Pillar 1 and 2?
Thank you so much. So let me start from the second point. Now, if you look at the OECD Pillar 1, Pillar 2 projects, it's actually a series of projects that the OECD have undertaken over the years. Now, if you look at the OECD, what they did, they started focusing on the BEPS action plans, that was 15, which transfer pricing actually sat in. So that's how one has been rolled out. A lot of companies have picked up on it. And the whole idea is that they want to find ways of controlling transfer pricing or base erosion so that companies doesn't suffer or countries that don't suffer in terms of losing revenue. The next question is that they brought in the Pillar 1, Pillar 2. Pillar 1, Pillar 2 is nothing more than also ensuring that companies pay the appropriate fees within each jurisdiction. Now, if you look at Pillar 1 actually is focusing on, they have amount A, amount B. Now, Pillar 1 has amount A, amount B. Pillar 2 has amount B. Now, if you look at Pillar 2, it talks about the minimum tax that companies will have to pay in this jurisdiction. So it's saying that if your global operations is within a certain jurisdiction and it's determined that your effective tax rate in that country is less than 15%, then you need to top it up. Even though Ghana, we haven't signed up onto the Pillar 1, Pillar 2, we are going to see that the companies are going to pay GRA additional funds when it's determined that the effective tax rate is less than 15% based on the countries, how they interpret Pillar 1. If you look at Pillar 2, Pillar 1 actually, the amount A, it was more digital tax which have not been used because of challenges. But the Pillar 1 amount B is focused on what we call simplifying transfer pricing rules for certain businesses. So those who are in retail and others, as long as your operating margin is set within, I think, 5% or so, then you don't have to actually focus so much on a lot of documentations on that. So pillar 1, pillar 2, they are all in the same way of addressing base erosion, but pillar 2 is focused on minimum tax in terms of global operations, and pillar 1 is talking about simplifying the approach for certain industries. So that's the second question by Jacob. Aaron's question actually talks about the TTA, which is the technology transfer arrangement by GIPC. What we've seen is that companies have actually have their TTA or related party arrangements, especially from services, management services, trademark, technical service, always, and others, being approved by the GIPA under the technology transfer regulations. It should be noted that the basis of approving the technology transfer arrangements by GIPC is actually typically based on the net sales. So you see that they say that if you are charging this by 3% of this net sales within this thing, then you can transfer the funds away. However, the question that is on the table is that GIPC's mandate has always been the transfer of the funds. GRA is on arm's length. So GRA will still not touch what you have agreed by GIPC, but they will say that, look, we know that you have been granted 4% of net sales for either management service or so. However, did you comply with the arm's length principle? Are you now saying, can you demonstrate that whatever charge, whatever service that you are talking about, you actually receive them, you can demonstrate that you actually receive economic benefit and others. So you see that they all sit within certain different pillars. It should be noted that the new transfer pricing regulations actually has adopted something from IPC, and as I indicated, if your profit before tax is around 4 or 5%, I'll confirm the numbers, then it will then qualify for transfer pricing. But as you see here, the percentage applied on net sales and others will be good for GIPC's purposes, but not for transfer pricing compliance. So I think that's the challenge here. We can talk about this later on if this is not clear to you. Now, Richard is talking about regarding the arm's length principle, how easy to get comparable transactions to access. And I think, Richard, that's a very good point. The good thing is that we have third parties that actually specialize in that. So what do I mean? We have third parties who have gone to pick data, independent data from the market, whether it is agreements for royalty charges, whether it is for financial data and others. And they've actually simplified these numbers into a database, which companies will have to subscribe to. Now, in this case, if I am actually doing work for you, and I need to demonstrate that the charges that you are being charged, or what you are paying for, is at arm's length, I need to now go into the database and then rely on that database to do that. And I think my colleague Kwesi has actually explained that this database by third parties is what we will be using to demonstrate that. So which means that we don't need to go and do surveys in the market. We already have them, which is good. Another person saying that, please, as an insurance professional, what transfer pricing method would you advise for the price of a management service from a group? I think this goes across board. And as I indicated, you could use the TNNM, you could use the cost plus, and sometimes you can even use the cap method, but it's on a case-by-case basis. So this is something that you really need to look at the case and each transaction as it is before you can do that. Dr. Kingsley is asking, what's the relationship between transfer pricing, tax avoidance, tax evasion, and tax shield? That is quite interesting. Now, if you take a step back and look at it, tax avoidance, tax evasion, tax shield, they are all sitting on the platform of transfer pricing. Because if you have a proper transfer pricing robust basis, you'll be able to do tax avoidance by clearly demonstrating what you are actually doing. That, look, I'm not breaking any law. I'm being charged for these services. It's helping me to reduce my tax liabilities. However, these are the third-party arrangement, third-party assessments that we have done to support that. And therefore, having a proper transfer pricing base or process will actually feed into your tax avoidance, meaning that you avoid paying taxes illegally, not illegally. Vice versa, if you go to tax evasion, if you have a transfer pricing, tax evasion meaning that you are illegally not going to pay certain taxes. And I think that's the point. However, if you have a proper, robust transfer pricing process, I think the issue of, from a revenue authority point of view, the issue of tax evasion will be addressed, because we know that even if you are being charged or you have a transfer pricing arrangement or tax arrangement, as long as your transfer pricing process is not robust, that means that you are now undertaking tax evasion. That is illegal non-payment of what taxes that are due. And I think when you are talking about tax shield, which actually sits with almost, it's trying to put together, saying that, look, you are trying to prevent certain taxes being charged also. It's all set from a transfer pricing point of view. However, you really need to take through the process actually to determine how this can be supported. So I think Dr. Kingsley, that is Kwabasin, that is the key point in relation to that. Okay, so I think I think one last question before then we go. I think Julius asking, please, how can you explain TP effects on intergroup payables and receivables and the interest that may have to be charged? Kingsley, Julius, that's an interesting question. The question is that if you have intergroup payables and receivables and you are being charged interest on outstanding any of them, the question is that, are you doing the same for your unrelated parties? So if, let's say, I come to you and you have that and you are not charging, why would you be charged? So all these things, if you go through a transfer pricing process, you come to a conclusion as to whether you need to be charged for outstanding payables or receivables when it comes to intragroup relationships. And then Jacob is saying, despite provision of where the Commissioner General is of opinion that a person may adjust. Yes. So if we take a step back, this is the general, this is the provision that has been given to the Commissioner General, that the Commissioner General used to address that. So I think in the essence of time, I think you can send your questions. We will definitely respond to them after this session. But thank you so much for your time. I think this hope that you it's worth your time. And I'll transfer to my colleague Ruby to take it from here. Ruby, thank you.
Thank you so much, Mr. Boateng, for doing justice to the questions. We have posted a feedback form in the chat box, and we would be glad if you could take a moment to complete the feedback for us. Your feedback is very important to us, as it will help us improve and continue delivering sessions that are very relevant and impactful. At this point, I will invite Dr. Kwabasin to deliver the closing remarks. Hello, Doc. You can unmute.
Yes, I'm here. I can hear you loud and clear. I believe in the audience, we have both accountants and non-accountants. We have typical insurers and so on and so forth. So some may ask why we will drag them in. Those who are not accountants will ask why we are dragging them into that space. It's very important for us to know what is happening, because the insurance industry now, it does not comprise just of insurers properly to go on, but then other services as well. And so we must have a holistic view if we want our companies to operate in the arena of profitability. And so I thank all of you for participating, and I thank KPMG for teaming up with us to bring this series. We will have a lot more to do. And for our audience, thank you very much for staying through. Please, if there are topical issues that you would want us to address, feel free to share with us. We will take it and look at it and see how we can be able to deliver. My closing remarks, in the form of closing, please refer to Section 158 of the Insurance Act, which talks about group financial statements, and then Section 41, which talks about the fact that there is no composite insurance, but certain relationships are allowed. and it will tell you that transfer pricing is closer than you think. Thank you very, very much, and may God bless us all.
Amen. Thank you so much, Doc. Ladies and gentlemen, we have successfully come to the end of today's maiden edition of the Future Ready Insurance Series, focused on transfer pricing for insurance. We would like to use this opportunity to express our profound gratitude to the GIA, specifically Dr. Kwabasin and his team, for this collaboration, for availing their time and resources to make this webinar a success. Our sincere appreciation also goes to you, our dear participants, for your time and active engagement. It's our hope that the discussions today have enhanced your understanding of Ghana's transfer pricing regime for insurance. Currently on your screen is our contact details. Kindly reach out to us with any questions or any further assistance you may require. We encourage you to stay connected with us for the next editions of the series as we continue to explore topics that matter to insurance. Thank you once again for joining us, and we wish you a productive and a successful week. God bless you. And kindly do not forget to complete our feedback forms. We'll be very grateful. Thank you and bye.